Hi there, I'm Sup Day. I'm a chartered accountant and I'm hoping to do some tutorials in financial accounting and reporting, and this might help students who are sitting for accounting examinations. Right, our objectives are to look at the format and content of cash flow statements. Following that, look at the cash flows KPIs or key performance indicators. Cash flow statements, main categories. The cash flow statement shows the movement of cash in a business during an accounting period. Now these movements of cash can be put into three categories in what is called a cash in or cash out. Cash generated from trading operations. Now this could be a surplus or it could be an outflow. In other words, you made a loss. Cash used in investing activities. This is usually cash used in the purchase of assets, and this is cash outflow. And 3, cash used in financing activities, in other words borrowings, and this is again a cash inflow. All these 3 categories are netted off to produce a single cash inflow and outflow, which could be positive or negative. They are either added or subtracted to the starting cash to produce a closing balance, which we call the ending cash. In the next slide, we'll look at the format of the cash flow statement. Let's first start off with looking at the basic cash flow statement format. In other words, how are those movements in cash presented? Now, the first category is the net cash from operating activities. The second category is the net cash from investing activities. And the third category is the net cash from financing activities. As you can see, they're netted off, and you can either have a net increase or a decrease in cash and cash equivalents, and that is then added to the opening balance of the cash at the beginning of the year to produce a closing balance at the end of the financial year. The word cash and cash equivalents comprise cash balances and bank deposits with an original maturity of 3 months or less. Now the cash flow statement, the basic cash flow statement format that we're looking at, or the condensed version, can be prepared using either the direct method or the indirect method. Under the direct method, the only section of the statement of cash flow that will differ from the indirect method is the cash flow from the operating activities. Now, the direct method is, however, rarely used, as the information in it is difficult to assemble. Companies simply do not collect and store information in the manner required for this format. However, we will look at the format or what is included in the direct method, so you get an idea, the main inflows and outflows using the direct method. So you can see here, for example, in the cash inflows, you have got cash sales, cash received from debtors, cash received from commission and fees, royalties received, and on the cash outflow side, we have the cash purchases, payments to creditors, cash operating expenses, payment of wages, and income tax. These are broadly similar to the items that you would find in an income statement. In the next slide, we will look at the operating activities using the indirect method. In this slide, we will look at how we work out the cash flow from operating activities using the indirect method. We start off with the operating loss or profit before interest and tax taken from the income statement. We then adjust this figure with the non-cash expenses or income that appears in the income statement. For example, depreciation amortization charges are a non-cash expense that reduces profit in the income statement, but because it has no cash flow effect, it's added on to increase the cash flow from operating activities. Another example is a gain on disposal of fixed assets. This is essentially a balance on the disposal account where it's an accounting gain which has been transferred to the credit side of the income statement, but again, because it has no cash flow effect, it reduces the operating profit to get the cash flow from operating activities. Finally, we look at another example, and this is the equity settled share-based payment expense. Again, this does not involve any transfer of cash, but is settled by a transfer of shares. So again, that reduces the income statement, but again, because it has no cash flow effect, it is added back. The net result is an operating cash flow before movements in working capital. Next, we consider the changes in working capital. This could involve either an increase or decrease in inventories. Here, we appear to have a decrease in inventories, which means that the closing inventory was less than the opening inventory, and therefore that has a positive cash flow effect or inflow of cash. The next we consider is the increase or decrease in trade and other receivables. If you increase trade and other receivables, in other words, if the closing balance of trade and other receivables is more than the opening balance, that reduces the cash flow and therefore it is taken away. Finally, we have increase or decrease in trade payables. This is a decrease, and which means that you're paying off your trade creditors more quickly, and again that has a negative effect on the cash flow. Again, these are all adjusted to the operating cash flow before movements in working capital to arrive at the cash flow generated from operating activities. Next is the interest paid, which is a deduction, interest received, which is an addition, and finally corporation tax paid, which is a deduction. And that gives us the net cash flow from operating activities. Now, IAS 7 does not specify how to classify cash flows from interest paid and interest received. Many PLCs treat interest paid as a financing activity similar to dividends, as both are seen as a cost of obtaining finance. Interest received is classified under investing activities. In this slide, we will look at the net cash from investing activities and the net cash from financing activities. The cash flow from investing activities, interest received, this is a cash inflow. Investment in subsidiaries, this is the actual cash consideration paid for the acquisition of subsidiaries. This is a cash outflow. Purchase of property, plant and equipment, this is a cash outflow. Purchase of intangible assets is a cash outflow, whereas the proceeds from the disposal of assets held for sale is a cash inflow. The net cash used in investing activities would be either an inflow or an outflow, and in this case it's an outflow. Next, we look at the cash flow from financing activities. dividend payments is a cash outflow. The drawdown of revolving credit facilities, again, it is a facility that the company has with a bank in case it has an emergency need for cash, similar like an overdraft. And so that drawdown is a cash inflow, and subsequent repayment of the revolving credit facility is a cash outflow. The net interest paid could be on bank balances or lease payments, is a cash outflow. And finally, the repayment of lease, the principal amount, the capital amount, and this is a cash outflow. Again, we net it off and we have a net cash used in financing activities, which in all probability would be a cash outflow. In the next slide, we will have a quick review of the income statement of Superdry plc as the indirect method, which is the way we compute the cash from operating activities, requires a reconciliation of the operating profit in the income statement with the cash generated from operating activities. In preparing the cash generated from operating activities, we start with the operating loss before interest and tax of 159.4 million from the income statement. In the next slide, we will look at Superdry's cash flow statements. Attached above is the condensed version of Superdry plc's cash flow statement for the year ended 30th of April 2020. And our first task is to calculate the cash generated from operations, and to do that we start with the operating loss stroke profit before interest and tax, and in the case of Superdry it was a loss which was 159.4 million. Right, the next adjustment is the non-cash adjustments of 234.9 million, which are deducted from the operating loss as they have inflated the operating loss in the income statement. Let's have a look at what those non-cash adjustments are. The first one is a gain in derivatives. The company obviously has a lot of foreign exchange contracts, and it is required that where you deal with derivatives or foreign exchange contracts, you should have value it at fair value at the year end. And that gain, which is the non-cash adjustment, would have been reduced the operating loss. But in working out our cash flow statement, we would add it to the operating loss. Depreciation, PP and right to use assets, these are non-cash adjustments, so we've got to take it away from the operating loss. Same as amortization of intangible assets. Impairments of PPP and right to use assets, these are all non-cash adjustments. Here there is a decrease in the onerous contracts provision, so we've reduced the provision. So in the income statement it would have reduced the operating loss, but in a cash flow statement it would increase the operating loss. Foreign exchange gains, and finally we've got write down of inventory provisions. In other words, we are making more provisions because the stock is obsolete. And finally we got bad debts provision of 15.3, and if we add them all up it comes to 234.9. In the next slide we will look at the changes in working capital and its impact on cash generation. In this slide we will look at changes in working capital, which in Superdry plc's in 2020 involved a net inflow of 12 million. This involves changes in inventory, trade receivables and trade payables between the beginning of the year and then the end of the year. As an example, inventory holdings between the beginning of the year and the end of the year decreased by 21.6 million, and this is a cash inflow. There was a decrease in trade receivables, again between the beginning of the year and the end of the year, and this is a cash inflow of 14.6 million. A decrease in trade payables by 24.2 million is a cash outflow as the entity is paying the creditors more quickly. In the next slide, we will consider the cash used in investing and financing activities of Superdry plc. In this slide, we will look at the cash flow from investing activities and the cash flow from financing activities. Let's look at the cash flow from investing activities, and this is usually an outflow of cash, but any proceeds from the sale of current assets are included in here. And if we look at the breakdown of the entries in the cash flow from investing activities, you'll find, for example, the purchase of plant, property and equipment is an outflow of 6.4 million. The purchase of intangible assets again is an outflow of 7.5 million, whereas the proceeds from the disposal of the assets held for sale is a cash inflow, giving us a net cash used in investing activities, which is an outflow of 11.5 million. The next thing we look at is the net cash used in financing activities, and it includes dividends and interest payments. Again, if you look at the breakdown provided in the financing activities, you'll find that there is a dividend payment, which is an outflow of 3.4 million. There was the drawdown of cash from the bank, as I said, similar to an overdraft, where there were more payments than receipts, and therefore there was an arrangement that the bank will extend a credit of 30 million, and which they did, and at some point later they repaid it back, and it was an outflow of 30 million. Net interest paid was an outflow of 7.5 million, and the repayment of lease principals, so the capital element, was an outflow of 61.1 million, giving us a net cash used in financing activities of 72 million. All the three kinds of cash flow, by that I mean the operating activities, the investing activities, and the financing activities, are netted off to produce a net increase of cash inflow 1.8 in the year. Then there is this exchange loss of 1 billion, which has resulted from translating cash and cash equivalent balances in foreign denominated currencies in the pound, and that is a loss, so it's a deduction, and that ends up with a final balance of cash and cash equivalents at the end of the period of 36.7 million. In the next slide, we will look at the various KPIs when reviewing cash inflow statements. In this slide, we look at the cash flow statement key performance indicators. The first one is the cash flow from operations, in other words, trading operation. What is the cash generated from trading operations? Second is the cash conversion ratio, and what we are looking at here is the percentage of the accounting profit that has been converted into cash. Then there's the free cash flow to the firm, in other words, what is the cash available for distribution to the long-term providers of capital, which are the shareholders and the long-term debt holders. Then we have the free cash flow to equity. In other words, here we're looking at what is available for distribution to the equity holders or the shareholders. And finally, we have the year-end cash balance. In the next slides, we will use Superdry PLC's cash flow statement to explain the various cash flow key performance indicators. The first KPI is the cash generation from operation, and is the amount of cash a company generates from carrying out its operating activities over a period of time. In case of Superdry, it's 1 year. Most companies use the cash generated from operations before interest and tax, and in Superdry's case it generated 87.5 million, and this is compared with the cash generated in the previous year. A company can also use the cash generated from operations after tax, in which case the amount generated is 85.3 million. The second KPI we're looking at is the cash conversion ratio. This ratio assesses a company's efficiency in converting its profits into cash and helps to assess a company's earning quality. The CCR can be expressed either as a multiple or as a percentage. You divide the cash from operating activities before interest and tax by the accounting profit or loss before interest and tax. A high CCR, typically above 1, is better than a lower CCR, as it indicates a business is able to convert a majority of its earnings into cash. Where a company made an accounting loss but a cash profit, then first calculate the difference between the two, which is the cash profit minus the accounting loss figures, and divide that difference by the accounting loss figure. Superdry CCR is calculated as follows. Now, Superdry made an accounting loss. So we have the cash profit in the workings, which is 87.5. We've got the accounting profit stroke loss, so it's made a loss of 159.4. The difference between the cash profit and the accounting loss is 246.9 million. What you then do is to divide that difference, which is 246.9, divided by the accounting loss of 159.4 times 100, and you get 155%. You can express that as a multiple also as 1.55. Some companies prefer to use the EBITDA, which is the earnings before interest, tax, depreciation and amortization, as the adjusted profit to calculate the CCR. Now let's see what the EBITDA is for Superdry PLC. We've got the operating loss before interest and tax, which is 159.4 million. We add, or we take away the depreciation, which we get from the cash flow statement, which is 78.5 million. We take the amortization again from the cash flow statement under operating activities, 8.7 million. And this gives us a reduced loss of 72.2 million. To work out the CCR, we divide the cash operating profit, operating activities before interest and tax by the EBITDA. But given the fact that this company made a loss, we have to calculate it from by taking the difference between the two. So you got the cash operating profit, which is 87.5. We got the accounting loss, which is 72.2 million. The difference is 159.7, and you then divide the difference by the 72.2 million of loss to get a percentage of 221, or a multiple of 2.21. The next indicator we're going to look at is the free cash flow to the firm, or FCFF. This KPI measures the cash flow available for distribution to the entity's long-term capital holders, shareholders and debt holders. The free cash flow is worked out by taking the cash flow from operating activities after tax and then take away the capital expenditure which is included in investing activities. For Superdry PLC, the FCFF is 85.3 million, which is the net cash generated from operations after tax, take away the capital expenditure of 11.5 million, and we're left with a cash flow, free cash flow of 73.8 million. Another variant of this free cash flow to the firm is called free cash flow to equity. In other words, how much cash can be paid to the equity holders. The formula for that, to work it out, is again to take the net cash generated from operations after tax, take away the capital expenditure, plus new debt, minus debt repayment and lease repayments, and minus interest payment. In Superdry PLC FCFE, we take again the net cash generated from operations after tax of 85.3. We take away the 11.5 million in capital expenditure, and if we look at the cash flow from financing activities, we take away the lease repayment of lease principal of 61.1 million minus the 7.5 million of interest paid, and we end up with a free cash flow to equity of 5.2 million. Last indicator we're going to look at is the year-end cash balance. And in Superdry's case, if we look at the bottom line at the cash and cash equivalents at the end of the period, is 36.7 million, and this figure is compared with the cash balance in the previous year, which is 35.9 million in 2019, which is the opening balance. And effectively what we have is there is a net improvement of 1.8 million during the year.